Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And today I wanted to talk about a major frustration that stock traders will commonly encounter. We go to all of this trouble to select a specific stock and then watch as that stock underperforms and the rest of the market seem to head higher and higher and higher. Why is everybody else getting all of this bullishness while we get left in the dust? Well, sometimes it may not be entirely the trader's fault. Sometimes the markets can create an illusion of bullishness that actually not very many people are able to participate in. That's what we call a narrow market condition, where there's not much breadth in the bullishness. It's actually just a few of the big players giving the illusion that the markets are generally heading higher. So today we're going to be talking about using charts to gauge what we call market breadth. How many stocks, what percentage of stocks are really able to participate in the strength of bullish markets? So I'm really looking forward to this. We're going to be using a combination of technical indicators, the advanced decline line and the McClellan oscillator in an example systematic approach to assessing that breadth. We're going to be talking about what those indicators are and how they might be used to gauge the breadth. But before we can get to any of that, let me first of all say hello to everybody who's already chatting in. Great to see so many familiar names out there, a few new ones. But hello there, Sonia on Tiny, Mark, Kelly, Andrew, William, Selva, Chris B, Sharon, Daksha, David, Jack, and on that list goes. Thanks, everybody, for being here every Friday. Really do appreciate your attendance and your contributions. If you are among those that are new, and there were a couple of those names that to me seemed a little new, welcome. Glad to have you on board, and I hope that you will put it in your personal calendar to join us each Friday if you'd like to. Of course, you can just watch the archive. That's fantastic too. I also want to say hello to anybody that might be watching on those archives. If you're watching the recorded version of this presentation, enjoy, but be aware that you're invited to join us in the live streams. If you'd like to join us, this is, as I mentioned, the Friday webcast series, and we kick things off promptly at 1 Eastern time. Now, I also want to let everybody know that my very good friend, Ben Watson, is going to be hanging out in the chats with us. Ben is an absolutely fabulous presenter and coach. Ben and I have been working now together for more than 20 years. So Ben brings a wealth of knowledge and experience to this discussion. Ben's going to be answering any questions that I can't get to that pop into the chat. If I can't reach out there and answer those just during the flow of the discussion, Ben's going to be there to pick up my slack. So thanks for having my back there, Ben. And Ben and I will like to issue an invitation to everybody watching, everybody listening. If you have an account with X, give us a follow there on X. You should be following your favorite presenters there. You can find Ben on X at Ben Watson CS. You can find me there at Cameron May CS. That is the best place to connect with us in between the live streams. But let's get into this discussion of market breadth. And as we do, of course, it carries risk, just as does every decision that a trader or an investor makes. So bear these important disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including loss of principal. Mark says, I love getting introduced to new studies. You can't wait. That's fantastic. So we're going to be covering a couple of them here, Mark. And so what I'd like to know, we're going to be talking about the advanced decline line. And we're going to be talking about the McClellan oscillator. Let me know, are you familiar with one or the other or both or neither? Go ahead and chat in. There's absolutely no shame in not knowing everything about everything when it comes to stock charts. So there's so many things to know. But we are going to be exploring these oscillators. So let's set the agenda as you're giving me that feedback. Set the agenda for what we're going to be talking about with our 45 minutes together today. Number one, we're going to be reviewing existing positions in our paper money portfolio. I've been out having fun on vacation, actually on and off of vacation, and then did a little bit of work, and then I decided to do some more vacationing. So anyway, I've actually been out of this webcast series for like 6 weeks. So we need to play a little bit of catch up, look at our existing positions, revisit the logic of those positions, make any adjustments that may seem to be pertinent. Then we're going to take a peek at the markets, but we want to frame that through a new technical lens through those two breadth indicators. And then we're going to use those two breadth indicators in combination with one another to build an example system, a systematic approach for assessing how broadly are the markets experiencing strength or weakness, and how might a trader use that for potentially the timing of entries of new trades. So let's go right to the Thinkorswim desktop trading software platform. And I'm seeing Bill says neither one, or you're not familiar with either one. Selva says no. Ricebird says familiar with both. Greg says nope. Chris B says both. Ed, I've heard of them. Yeah, but it seems like, and this is not surprising to me, with hundreds of technical indicators out there and hundreds available on the Thinkorswim desktop platform, we're not going to know them all, right? So it's just my job as an educator, just make us aware of the tools that are available should we choose to use them. But first of all, let's look at our existing positions. Let's look at what caused us to take these trades and what's happened to them since I decided to just turn my back on them and head off into the wilderness for 6 weeks. So first of all, we have AbbVie, 25 shares. Shares are not doing well. That's the way things go sometimes. Let's go look at the chart. So this one was taken as what's called a ribbon study trade. And I know Ben has done some great ribbon study discussions in the past, so you may want to check those out on our archives if you haven't seen those. But this trade was taken as our RS1 line. That's our fastest ribbon, our fastest basically moving average in our ribbon study, crossed up over RS2, the second fastest. So there was our entry here, and a typical entry and exit using this ribbon study is when RS1 crosses RS2, there's an entry. If it crosses back down through RS2, that could be an exit. So there was an example back here that might have produced a profit. This one, nope. Actually, entry here, exit was down here. So this one would have been unprofitable. And yeah, we're still sitting on a loss in our paper money. And really, you can see that our thicker RS1 line is still solidly lower than the RS2. So what I'm going to do here, since we need to play a little bit of catch up, I wasn't here to talk about selling at this time. Let's sell it. Let's go back to our monitor tab. Let's just wrap this one up. Right click on ABBV. Sometimes a trader takes losses. Sometimes they might be larger losses than intended if they aren't keeping an eye on things, or if they don't have, let's say, a mechanized exit signal or exit order entered. In this case, since we were waiting for a crossover, we could potentially mechanize that to some extent using ThinkScripting. I don't go too far with that. I like to discuss what we're doing in the webcast series live on camera. So let's sell these 25 shares. Looks like they're trading at 189.29. We're going to be realizing somewhere along the lines of a $300-ish loss. I'm going to change this to a market order. Markets are open. AbbVie is a fairly heavily traded security. There's still risk, though, when placing a market order. If the market is moving rapidly, we might not be very thrilled with the price that we get. But let's click confirm and send. We're going to sell those 25 shares at the market price. With market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. Let's send that off. Okay. Now, some of you didn't see that ribbon study discussion, so you have no idea what in the world these wandering lines were. What is that ribbon on Cameron's chart? Well, you can find our previous webcasts, like Ben's webcasts and my webcasts. Make sure, first of all, that you have subscribed to our Trader Talks channel. It doesn't cost anything to do that. You can do it in about 1 second by going down to that lower right-hand corner, clicking on the little subscribe icon down there in that lower right corner. But our YouTube channel is where we house our previous webcasts. So the channel name is Trader Talks Schwab Coaching Webcast. You can go here to our homepage, go to our playlists, and I'm going to scroll on down to the playlist for this series. It's about halfway down. Just scroll right down here. There it is, Advanced Charting Techniques. I'm going to click on View Full Playlist. And this is where you can find previous webcasts, such as, let's scroll down. until we see it. Where's our ribbon study? There it is. Trading stocks with the ribbon study. 8 indicators in one chart tool. All right. So there we go. If you want to see the other indicators that we're going to be talking about here in just the next few minutes, make sure that you're checking these archives out. Let's go back to our desktop. Let's go to our next stock. We have Amgen, 20 shares of Amgen. It's doing okay. But what was the logic of this trade? Let's go to AMGN. Let's switch this up. Now with AMGN, not only did I use a different technical study, the pairing of technical studies, use a different time frame. This one was for faster buy and sell signals. So we saved not a study set, but actually a chart style, including the studies. So I'm going to go up to my style. I'm going to load that style for our Amgen 20 triangular moving average and 5 exponential moving average trading system. There we go. And now this was so long ago. So this is really just looking back over the last couple of weeks. This is zooming in on an hourly basis. I haven't even had a webcast in that long. So our trade it's still off this left margin. So we need to extend this out. We're going to stick with the hourly chart as our time frame. But how about we go out 90 days? Let's click OK. There we are. So here's our entry. And in this example trade system, maybe I'll zoom in here. Let's just capture the rest of this. The trader might be taking the entry as the 5-period exponential moving average on an hourly chart crosses above the 20-period triangular moving average, which we generated right here, and then looking for a bearish crossover as just the opposite transpires. So there's a bearish crossover here, but we didn't exit. So what's happened since then? Well, we've had another bullish crossover here, another bearish crossover there, a bullish one here. There are actually a few whipsaws here with crossover systems where they can really tend to break down is when it starts to kind of chop sideways. Crossover systems will very commonly in those circumstances say buy here and sell there and buy here and sell there, and it generates a whole series of small gains and small losses. It can be a little bit frustrating. That's just inherent to the way these things work. They're attempting to get us on the right side of a longer upside move, or in the case of bearish trades, a longer downside move. But yeah, choppy, shorter term conditions can lead to some whipsaw events. But most recently, we had a bullish crossover here, signaling to a bearish crossover right there, meaning just exit that bullish position. Was there a little whipsaw there? I think so. But look at where we are right now. The 5 is above the 20. And I think since this is still at this moment bullish, let's not exit it. Chris B says it's come back to about where we should have exited. That's nifty. Yeah, we could. Yeah, look at that. Look at that. That's actually a good call out there, Chris. So what do we think? Should we just stick with it? Just let it play a little bit longer? If the trader is being more disciplined, obviously it would be, if their system is get in on a bullish crossover, out on a bearish crossover, we'd be done already. But how about we revisit this next week? See if it's slipped back down, if the 5 has slipped back down below the 20. And in that case, we'll take it off. But there's that Amgen trade. Now, finally, we have our AT&T position. So let's go to our charts. Let's bring up AT&T. We're going to have to load up our different study set. Now, I'm using different study sets here, not as a promotion of these different study sets, but just to provide a very rounded education on all of the tools that are available. Can't even get to all of them, but as many tools as I can help us understand what they are, how they're built, and how they might be used to build trading systems. Now, it's always up to the individual trader to decide whether any given tool is going to play a role in their portfolio. But let's go up here to our studies. Let's load up our final study set, which is our AT&T parabolic stop and reverse and 100 simple moving average study set. And let's switch this back to a 1-year daily chart, which is how this trade was taken. And so there's the original trade. With a parabolic stop and reverse, commonly the trader is looking for If you want to go back, you can watch the archive, just where I showed you to find these archives. But we're looking for an upward sloping moving average where price is above our series of dots. Now, as soon as the dots slip down below price, as long as that moving average is still heading higher, that's a potential signal in this sort of a trade system. Now, some might wait for a few dots, 2 or 3 or 4 dots. So we took this, I believe it was on the third, or I think it was right on the third one. Yeah. In any case, bought the stock, placed an initial stop 1% below the dots. And a common exit management technique is to manually raise that stop as the dots move higher. So look at where we are right now. We weren't here to manually raise these previously, so let's do it. So our dots still heading higher. Moving average is still heading higher. What's our final PSAR value? As I point at this last one, if you look right up here, this number in red, it's at 2672. All right. So if we move our stop to 1% below 2672, where would that have us? 2646? Is that right? Somebody check my math if I'm wrong. So this is all I did in my head. If the current PSAR value is 2672, we multiply that by 0.99 or subtract 1%, 2645. Yeah, a little bit of rounding. That's okay. Let's put it at 2645, or as close as we can. So Rita says, what is the sell signal on this? So Rita, it's literally, the sell signal is if we fall 1% below our rising dots. That's it. If we hit our stop. Otherwise, we stick with the position. Now, it's not the only way that this can be done, but if you want to see if you want to see a more complete discussion of this, of course, you go check out the archive for the PSAR discussion. But I'm going to click on this. So our stop 2645. Let's click on our pill here for our stop order and drag it up. And this is actually preparing a stop order. Let's get it right up there, 2644. That's within a penny. That's close enough. I'm just going to release that. And what that does is it brings up an adjustment to that stop. It cancels the original stop order and replaces it with a new one at this new higher level. So we're replacing the original to move that up to, looks like it moved it to 2643. We're talking pennies. Okay, maybe that's important to some traders. Probably isn't important in the grand scheme of things. There's no commission on this trade. But we need to always remember, with stop orders, there's no guarantee that the execution price will be equal to or even near the activation price. So we are not guaranteed that if the price falls down to 2643, that's the price we'll get if the order is triggered. If we get a big gap down, we might sell for significantly less. But let's send that order off. And there we go. We moved our stop up. Ambiance, thank you. I appreciate that. An amazing teacher. Oh, all right. That's a nice little boost. Thank you. All right. Anyway, let's move on to the S&P 500. So let's just clear off our studies. I'm going to come up here. Let's just remove. So if you don't know this, if you have a bunch of studies on your chart, you don't want to delete your study set, but you do just want to get them off the chart. Instead of taking them off one at a time under Edit Studies, you can go to the Studies icon and just remove them all. And it'll say, do you really want to do that, Cameron? Yes, let's do that. And let's go to the S&P 500. And here's what's been going on just through a plain candlestick chart lens. The S&P has been recently making higher highs and higher lows, a really dramatic recovery from this 22% sell-off that ended back here in April. Since then, we recovered. And how close did we get to those all-time highs right there? Let me do a quick measurement here, just out of personal curiosity. If we use our trend line tool, we can click in one spot, move to another spot, and it tells us the percent difference, the percent change. Look up here. This is what I'm looking at right there, percent change. So today's high we're getting close to about 2%. Hooray for the 401ks. That's good to see for those bulls. But yeah, we've been making higher highs and higher lows. But I would suspect that there have been plenty of traders, even in this condition, who have purchased stocks and then watched the stock market, as represented by the S&P 500, seem to be showing so much strength, and they think, awesome, let me go look at my portfolio. And they look at that stock that they picked, and it's just floundering, doing nothing. Well, in that case, what may be happening is that this could be, for some traders, an illusion of strength. Because is it possible that an index that's supposed to represent what the average stock is doing is actually getting exaggerated because you have a bunch of great big companies that are not a bunch, but a comparatively small amount that are performing really well, but they carry so much weight in the creation of that index that they create that illusion that everybody's having a great time. When in reality, it might be, I don't know, 20%, 30% of stocks are going up, the big ones, while a lot of those smaller, those middle-sized companies, maybe not doing so well. Now, I'm not saying that is the scenario here, but it is a scenario that sometimes happens. So we're going to be, yeah, Chris, this is a cap-weighted index. It means the market cap matters. The big companies have more pull in saying how this index performs. So for some traders, they like to sort of peel back the layers, and they want to know, well, how broadly are stocks able to participate in this bullishness? What is the breadth of participation in a bullish market? So there are a couple of ways to measure that. Probably one of the most direct ways is using something called the advanced decline line. Now, I'd suspect in this audience, a lot of you have heard of the advanced decline line. Its generation is relatively straightforward, but let's add that to our chart. Let's come up here to our Edit Studies icon. We could just go down in alphabetical order to advanced decline, or I can just type in ADV. Well, you'll notice it says advanced decline. We're not doing the cumulative average here. We're just doing advanced decline. We're going to add that to our chart. Here's an important observation. Notice NYSE here. I'll explain what that means. Well, let's apply that now and click OK. And that leaves us with this lower study. Kelly uses it daily. Okay. Yeah, Kelly. So what could this provide as insights for that would-be trader who's trying to gauge the breadth of participation here? Well, I think it's important to talk about how indicators are constructed. This one, as I mentioned, fairly straightforward. And I'm not. Sometimes I'll go over over here to my Scratchpad and type out how these things are built. I don't think it's really necessary here. Instead, the way that this is determined is we start at some point. Now, what this does is whatever chart time frame we're using, it starts at the start of that chart. And then we look at now we're looking at a daily chart. So this is going to do on a day-to-day basis. It's going to look at all of the companies that trade on the New York Stock Exchange. That's about 2,100. You know what? I'm getting tempted. I'm starting to think of an example that I might want to actually type out on my Scratchpad. Should I do it? Yeah, I might as well. Okay. So there are approximately 2,100 stocks on the New York Stock Exchange. And the way the advanced decline line is calculated is we take the number, I'm going to call it the number of advancers. Not really a word, is it? Is it? Maybe it is. Anyway, take the number. Let's represent that with a line. Number of advancers. What do I mean by advancers? I just mean from day 1 to day 2, the number of stocks that closed on day 2 higher than the close on day 1. They advanced in price. So we take the number of advancers and we subtract the number of decliners. And that gives us a value. And that becomes our advanced decline value. Our net advance, that's our net advancement. Now, it's not always a positive value, possibly a negative value. Okay, Mark, thank you. Yep, appreciate that clarification. John, it is a word. Okay, good. Yeah, it is. Yeah, of course it is. Sometimes when you're presenting and you're trying to move forward and toward your next thought, you don't have time to give real attention to what you're saying. Yes, of course it's a real word. Anyway, but yeah, that's our net advance, positive or negative. And so on day one, that's it. So let's say on day one, let's be positive here. Out of the 2,100 companies, let's say, well, day one we can't even do this because we don't have enough days to run the calculation. We're going to have to skip ahead to day two because you have to compare day two to day one. Day one doesn't have anything to compare it to. Anyway, let's say on day two, we had 1,500 stocks advanced, and we had 600 stocks, and I'm doing a little bit of rounding. I think there are actually 2,132 on the NYSE right now. Changes all the time. Anyway, 1,500 advanced, 600 declined. So what would be our net advance? And this would become our advanced decline value for that very first data point. It would be a positive 900. Okay. So then on day three, let's say not as good of a day. We had 1,300 declined. I would hope we always let's keep it consistent because it is advancers minus decliners. 1,300, or that's going to leave us with what, 800 advanced minus our 1,300 decliners. Net advancement would be 100 minus. Okay, so what would be our advanced decline value as of day two? Well, we take 500 and add it to 900, and our running total then becomes 400. That would be the final value that gets plotted on this chart. And on that goes. So let's just throw in ... We just continue that logic, and that generates our advanced decline line. Now, you might think, well, Cameron, doesn't that just mean that if stocks are going up, that our advanced decline line is going to go up? Because clearly more stocks are going up than going down, because that's how indexes work, isn't it? No, it's not how indexes work. It's if they are cap weighted, if they give greater emphasis to the larger companies than to the smaller companies. And as a matter of fact, look at how the S&P 500 got off to the initial maybe 1 or 2 week start here. Let me zoom in on this time frame right here. What happened with the S&P during this time frame? It advanced. What happened with our advanced decline line, though? It went down. What that means is that if we were out there blindly picking stocks, ignoring capitalization in particular here, we actually have less than a 50-50 shot at seeing appreciation in that value, at least during that time frame. That adds up to a lot of frustration for some traders who are out there trying to find individual positions. So this provides some deeper insight into the breadth of participation in this advance here. Yeah, in this case, it's the big guys creating an illusion of strength, if that's the way that we define strength. So that is our advanced decline line. And for some traders, they use that just all by itself. And what they're looking for here typically is for confirmation of the advanced decline line trend with whatever their preferred index is. So if the index is going up and the advanced decline line is going up, that means generally there is broad participation in this advance. And then therefore, they might feel a little bit more comfortable if it's their thing to be going out there and picking individual stocks. So that's one breadth indicator. Now there's another one that's sometimes used. Now there are actually a series of these, but I just wanted to try to tackle two today. A second one is called the McClellan oscillator, and it's built directly upon the one that we just learned. Now, some of you said you're familiar with some of these indicators. Who are my McClellan oscillator? I don't want to say fans, just people that are familiar with the McClellan oscillator. Let's see, John says, isn't it also true that only about 100 is traded regularly? I don't know what you mean by that, John. 100 what? I'm not quite sure. Okay. Anyway, yeah, who's familiar with McClellan oscillator? If you're not familiar with it, let's get familiar with it. It's a tool that's available on Thinkorswim. It's at least in my observation, just seems to be getting at least a little bit more attention recently. Seems to be on the upswing, not just on the chart, but in like social media and in the headlines. Now that's just a personal observation. It doesn't necessarily imply anything about the indicator, but let's add our McClellan oscillator. I'm going to come up here to our edit studies. Chris, you're familiar with McClellan oscillator? Let's type in MC for McClellan. There it is. Let's choose McClellan oscillator. Let's add that to our chart. And there are some key elements here. 1913. Now notice NYSE, still the base for this one. It doesn't have to be. That's customizable. We could switch it to the NASDAQ. We could switch it to the Amex if we wanted to, but I'm going to leave it with NYSE. But 1939, 100, and minus 100. Those are some important elements of this oscillator. But let's click apply and click OK. And let's talk about how this is built. So John says about 100 stocks that are regularly traded. No, actually, there are lots that are regularly traded. Yep. By regularly, I mean heavily traded. Yeah. In any case, let's look at our McClellan oscillator and talk about these numbers here. These really describe how this indicator is built. The last two just show you their reference to these red lines here. Now there should be, if I were to put in these numbers, I'd also include the number 0, because there's 3 lines. We have this blue line, we have a red line, and a red line. One of those red lines is at minus 100. One of those red lines is at positive 100. One of those red lines is at 0. So what are those things? Well, they actually rely upon our understanding of the other 2 numbers, 19 and 39. These are periods of exponential moving averages that are built using our advanced decline line value. So whatever this value is, most of us are familiar with using a stock price and building exponential moving averages using that. Well, that's doing the same thing. It's just not using the stock price. It's using the advanced decline line value. So it looks back over a given time frame and generates an exponential moving average of these values. So in this case, we're using 2 different time frames. There is a 19-period exponential moving average, a faster moving average of what's happening with our advanced decline line. And then there's a slower moving average, the 39-period moving average. That's of our advanced decline line. And then these 100 and the minus 100 are just ranges of how far above or below the faster one has gotten above or below the slower one. So it's really sort of a crossover system displayed in a different way. So John, you never heard of this oscillator? All right. So I know it's always a bit to absorb when I describe a new indicator. Yeah, that's a lot. So understanding what's going under the hood of a car can be complicated. What makes the engine tick? Well, that's one thing. Understanding how to drive the vehicle, not typically quite as complicated. Possibly more important though, right? So what is the 0? The 0 just means that the 19-period exponential moving average and the 39-period exponential moving average are right about the same spot. Our green line is basically tracking the distance or the difference between the 19 and the 39. When the 19 gets above the 39, we're going to see this green line rise, and hitting these 100 levels, either above or below, are sometimes interpreted as being extremes. Our advanced decline line is really getting strong in the short term compared to how strong it's been in a little bit longer term. So it might mean extra broad participation in bullishness. Kelly, you haven't seen this either? Rita says, would you change the exchange if you apply it to the NASDAQ? Yeah, Rita, I think that would make sense. I think that a lot of traders might do that. Although it might be serviceable enough to just know how broad is the participation on one of these major exchanges. All right, but yeah, when the 19 really starts to accelerate above the 39, that can be seen as really good strength in our oscillator. But actually, what may catch the eye of the would-be bullish trader is not when things have already gotten strong, but maybe instead when that breadth is starting to expand from the big guys out to it's starting to recruit the mid-range and the smaller companies into participation in this bullish market. So here's the way a trader might use this oscillator to set up bullish trade scenario. Now, in this case, we're really not looking for this is an entry signal on a stock and this is an exit signal on a stock. Instead, it's kind of like, well, is right now generally a good time to be looking at stocks at all? Or maybe I ought to just be pumping the brakes at this moment. That's more like how this might be used. But when we see this green line take a relatively severe dip down and then start to recover, think about what that means. It means that there has not been broad participation. At least this is the general interpretation. It's kind of a literal extraction of what's happening here. Not been broad participation in bullishness. Okay, when we see that green line going down, so at that time the trader might just be in a wait and see mode. But as the green line starts to strengthen, and especially if it crosses above that zero line, that might be a signal that we have quite a bit of strength here. So let's just look at this, maybe some of these zero line crossovers. And for some, it's more helpful to have a more specific, rather than just like a little dip below zero and then back up above zero, because it can chop around there some. Let me see, can we find it? Yeah, there's an example where we kind of just a little shallow dip below and then we went up, and a shallow dip below and we went up, with shallow dip below and we went up. For some, they may look at, well, did we get down below that 100 level? And after that, a crossover might be a sign that we're strengthening. Now, we're kind of ignoring something here, though. And well, actually, let's just illustrate maybe some of these. So here's a dip below 100 right here, followed by a cross above the zero line there. And look where that cross happened. Wasn't bad. It's not like stocks plummeted after that. We actually had about a week of buying before selling. Here we had another dip below 100 there. Kind of highlight that. Cross above the zero line, and we got strength right here. Journey 777 says, does the time frame used change anything? It changes everything. Yep. You want to see that? Let me pop up here because I think it's a good question. Let's just do this because I'll just pop right back. Go to a 3-year weekly chart. Yep. Now we're starting in a different spot, and our values have changed on both indicators. Now, it doesn't mean that we've done anything wrong. This might just be the way that maybe a longer-term investor uses this indicator. It might be entirely similar logic, just on a longer-term time frame. So we're learning on a 1-year daily chart, but these same concepts might be applied on different time frames. All right, but in any case, you're getting the point here. But this is using the McClellan oscillator in isolation. How about we combine these two? What some traders will do is they will first look to the advanced decline line and make sure that it is advancing, making higher highs and higher lows. And that doesn't mean that it has to be above its own zero line, which basically net just means that it's been negative since the start of the time frame. But just making higher highs and higher lows, that might be a time when the trader is thinking, oh, there's getting increasing breadth in participation here, bullishness. And then they might use, for more specific timing, a dip in the McClellan oscillator and then cross up above the zero line. All right. And it looks like most recently, that's pretty much what we've had here. Yeah. So what did we have just very recently? Didn't quite, oh, that was close. Didn't quite get down there. We have crossed that zero line. So we got most of it. Oh, I just noticed there has been a survey added to the chats. Did I just miss that earlier, Ben? My apologies. I did. Yeah, Ben's just been reposting it. Thank you for doing that. Yeah, there is a survey, so make sure you fill out that survey. If you haven't filled out one of our surveys, you just click on the survey link in the chat window. It's just a couple of multiple choice questions, a comments box and a suggestion box, but I promise I'll read through that information. I read through the data. I read through your comments. It definitely helps. All right. But yeah, pre-qualifier for even looking for a signal down here is to see that we're getting higher highs and higher lows on the advanced decline line. Then we look for that signal below. So there are going to be times where it may signal, such as here, advanced decline lines going one direction. We did get a crossover signal there. And you can see that kind of faded fairly quickly. All right. Now there's a final potential signal here. Still possibly looking, well, hold on. I'm going to back away from what I was about to say. Anyway, still looking, though, at our McClellan oscillator. There are times when it really takes a deep dive. When it dips down to or below 200, that can, to some, mean that there's been very narrow participation. And very commonly, we're going to be seeing our advanced decline line coming down, leading into those events where our McClellan oscillator dips all the way down below minus 200. But if we get down below 200 and pop back up above, for some, they see that as a potentially very important reversal point, possibly for markets. Right there is where we crossed back up above 200, right there. Didn't quite, did we get down to 200 here, minus 200? No, we got to minus 190. That was awfully close, but you can see how, yeah, that kind of coincided with a pretty sharp dip here, pretty sharp dip here, and a shallower one here, but still prices advanced for the most part from there. So guys, two new breadth indicators for some of you. For some, it was familiar. Maybe we were just revisiting familiar territory, maybe seeing it through a different lens, because I do like to present a couple of different ways that a trader might view these things. But I hope you enjoyed this discussion. Market breadth by some is seen as being essential. Not everybody holds that opinion, but I wanted to talk about those two indicators, our advanced decline line and our McClellan oscillator, and how they might be used in combination with each other to gauge how strong are markets truly. So, Greg, you're welcome. Everybody, I'm going to go let you enjoy the rest of our webcast and then have a great weekend. But I want to throw out a few reminders. Number one is, if you haven't subscribed to our YouTube channel yet, do that now. You can pop down, click on the subscribe button. It doesn't cost anything. But the channel is where we house our previous webcasts. We arrange them neatly by topic, by series. I also want to make sure that you're invited to follow Ben and me on X. You can follow Ben on X at Ben Watson CS. You can follow me there at Cameron May CS. I really want to emphasize, make sure that you're precise with the handles that you choose to follow, because there can be similar sounding usernames on social media, totally different people. Yep. So yeah, make sure you look for at Cameron May CS, at Ben Watson CS. Now, third thing is, there is that survey. Thanks for reposting it, Ben. But everybody, go ahead and click on that survey link now. Any honest feedback is always appreciated. Let's see. So I just saw a chat here that says you missed a lot of this. You'll rewatch it. Yeah, this is one of those webcast series. The vast majority of our webcast series are recorded, and we post these things to our YouTube channel. So yeah, enjoy that. If you need to play a little bit of catch up. Finally, thank you to everybody that already clicked the thumbs up button. That always is appreciated. That helps my webcast find a bigger audience. It gives a boost to the YouTube algorithm when the audience is saying, hey, we like this. YouTube says, oh, people like this and they show it to more people. So it helps more people learn these sorts of things. So definitely, if you've enjoyed a webcast, if you think it has value, click the like button, give us a boost. That's always appreciated. Plus, it's a nice pat on the back to the presenter for their efforts. All right, everybody. Thanks a lot. Go enjoy your weekend. I will see you in a future webcast. I'll also look for an X. Ben, thanks for helping out in chat. And whenever I see you all again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.